Good day, everyone. Welcome to today's market debrief. Today's date is 13th of May, and what we have on the screen is the S&P 500 index. And last night, the Dow Jones was like down. Sorry, the S&P 500 was down 2%, about 90 points down. And all in all, it continued on the correction as I've mentioned over the past few weeks. We should be expecting a correction to happen, and all in all, the correction is only about what 4.2%, for the S&P 500 index, and the Dow Jones is also similarly about 4.3%, and the Nasdaq, which is more tech heavy, there's a sell down. Mainly, they are drop or down a total of 7.8% from its recent high. Now, I want to bring out a very real risk, that I've mentioned in the past few videos, or even for the past few months, is that the inflation risk, especially in the U.S. market, is very real. Okay, inflation basically there are two types. One is caused by supply and demand, and the second type is by monitoring easing, meaning to say the government are printing more money, having more money into the market. All right, so the supply and demand are mainly because the prices of basic commodities and energy prices are going up. Okay, that's one. And number two, there are lots of labor shortages, due to the current pandemic that restricts movements between countries, between states, and and it's causing a lot of problems in the US and around the world. Okay, so take for example the news right now here is that the recent inflation saw like about 4+% compared to a year ago, and you can see in the picture here mainly there's an unavailable due to gas shortages. Okay, it's not that they are not producing gas, or they are using too much gas, but there isn't enough trucks or drivers to drive the gas, to the gas stations. All right, so the shortages are causing all these prices to go up, the demand for it to go up. Okay, and if we look at some of the uh, other news, that they are trying to reopen the economy, and you can see that, a lot of chicken wings, diapers, cars, or whatever items are in short supply. Like computer chips, used car, rental cars, gas. All right, so there are mainly a lot of shortages happening right now in Singapore, but sorry, in the US. As for Singapore, we are also facing a similar kind of shortages, meaning more like manpower. We are a very small state, and we required a lot of manpower from different countries, from China, from India, Bangladesh, Pakistan, to take up all these jobs, in security, cleaning, logistics, and even in construction. As we have known, some of the big news, HDB is they are facing delays of 6 to 9 months for their so-called affordable housing, for the masses. And I mean, you look at some of the recent sales launch, you're expected to wait like 5 years for a new house. Okay, so this kind of shortages is very real. And on top of that, if we look at some of the pricing, mainly for on the futures, okay, this is your copper futures. Okay, is on a big rise. All right, we have our steel futures. Okay, is running on a high. Lumber futures. Okay, there's some recent euphoric movement. Recently there is some correction. Okay, but it's nonetheless is on a very big rise in the movement. Okay, and if we continue to look at some of the, like, what corn futures, your sugar futures, wheat futures, the prices are up. All right, your cooked palm oil prices, okay, is making new highs recently, the past few days. And on top of that, we also have metals. Okay, we start to see gold breaking off from the bottom. Okay, trying to reverse its trend upwards. We have palladium on a new high. Platinum resting on the high side. All right, and silver is also like forming a pattern, trying to break off on the new high. Okay, so the metals, the commodities, all are going up. All right, so this in terms of commodity prices, we are right now in the so-called end of the bull market, which means in terms of cyclical stocks, in terms of commodities, bull run, we are in this stage. Okay, and the second part of this inflation risk, which is the monetary easing, right, by the U.S. government. We can see that mainly the dollar index it's been down for the past 1.5 years. All right, and we can just see that the dollar value is going down as compared to the foreign countries, to the six major trading partners, your US, your your euro, your Japanese yen, Chinese renminbi, Swiss franc. So the US dollar is weakening throughout against the commodities, against foreign currencies. All right, so the inflation risk is very real for the U.S. economy. Okay, so right over at our Asian side, we have our Hang Seng Index. Okay, well, today is a Singapore holiday, but the Hong Kong market is open. Okay, and we can see that despite U.S. sell down last night, the Hong Kong market is still up. It's still holding well. All right, if you look at the China market, the Shanghai Composite Index is still up, is green, all right, or trading sideways. So meaning to say, this Hong Kong and China market, I would say, relatively in a short-term period, is the relative strength is still quite strong, mainly because they have corrected first. They already corrected like 10%, from its recent high back in February. Okay, so um, we should be I think I should be expecting the Hong Kong and China market to pull the global economy back up again. I don't know. Okay, we have to see how it turns out. Okay, I'm expecting the US market to drop more before we have a real rally run up, due to inflation. Because if inflation will continue to rise, and the Fed has no more tools to curb this inflation, they have and asset prices will bound to rally to record highs, and what the government will need to do is to raise interest rate. So if that were to happen, the real crash will happen. Okay, so we just have to monitor the whole situation right now, because we are definitely in a bubble. Okay, now for our Singapore market, after a very nice rally, do bear in mind that we are just around at the pre-COVID days. Okay, in the region of 3,200 area, 3,100 area. Okay, so I've already drawn this box. What a 10% correction will look like. Meaning to say most of the stocks would drop down to 2009. Okay, so if we take a look at the bank stocks, right, because the banks are the one mainly moving the Singapore market. Okay, so we should probably expect like DBS to drop down like what, 26 $27. OCBC to drop down to like 11, 10 plus 11. UOB to drop to about like what, 24, 23, $24. And the SGX, probably 9 plus again. All right, so that should probably make STI drop down to about 2009 level. So if that happens, we can look into accumulating in the bank stocks again, for the next run, or probably the last run. We'll take a look at some of the stocks that I mentioned last week. Okay, last week I mentioned about AEM. We can look to short AEM. So if you have shorted this stock, you'll probably have made like what, 30 cents profits. So at this moment, due to this extended down move, expect some rebound to happen. Okay, so once the rebound happen, you can look for new opportunity to short the stock. As I've mentioned, their revenue is down 50%. Most likely for the whole year, their revenue is going to be down. So expect the stock prices to be down in anticipation of this full year result to be down like 30-40%. All right, so you can look to short these stocks after a rebound. Okay, I've mentioned about commodities, utilities prices all going up. I've mentioned about power assets. Okay, I've mentioned power assets roughly about 45, and I've also mentioned power assets about 48. Last week, and thereafter you had a continuous 3 days rise. Okay, so it's on a strong uptrend. All right, so I think there should be some small minor consolidation before it continue its rally upwards. Okay, and then there's also a possible reason for this move is due to its dividend coming up in May. Okay, so bear in mind of that. The other stock that I mentioned in conjunction that deals in gas is your Hong Kong China Gas. Okay, so last week it was like it just started to break out, and then it had a 3 to 4 days rally thereafter. Okay, so it's running in tandem together with the power assets. Okay, so this one deals in gas distribution. Your Bank of China. Okay, so it's consolidating sideways. So you have to be careful of this. This one can go both ways. They are coming out dividends soon. Okay, probably end of May or somewhere in June. Okay, so they are giving out dividends like once a year. All right. So and it has been increasing dividend rate for the past 3 years, 3 to 4 years. So if they're going to increase the dividends again, most likely it might shoot up. Okay, so but it shoot up really before it's XD, it might have a sell down. Okay, or if the dividend doesn't excite people, it might sell down. People will just sell down because this whole rally they have already earned their dividends already. Okay, so they might sell off, and forgo the dividends. Okay, Hang Seng Bank last week also mentioned about this stock. There's a breakout. Okay, and it continued rallying for 2 more days. Before consolidating and settled back down. All right. So the bank stocks in Hong Kong and China, surprisingly, it's resilient. It's quite strong. For Singapore market, I don't think we have much stocks to look at. So I'll probably just focus on the sector that we should be looking at, which is mainly the commodity sector. Okay, since I've been mentioning about the commodities run for some time already. Okay, we have a small cap here. We have a Geo Energy Resources. Okay, yesterday we had a big rally. Okay, a breakout. All right, so this is likely going to be an uptrend. Okay, seeing this as a few days rally and the pullback and ready breakout again. So wait for a pullback, for a opportunity to enter for the uptrend. Indo Food Agri. I've not monitored this stock for a long time, but yesterday have a strong rally also. There's a breakout. Okay, bear in mind that it's quite an illiquid stock. Golden Agri, we have a breakout again. Continuing its uptrend. Well, as I mentioned, the crude palm oil prices, commodity prices are all on an upward trend. All right, so all these companies are bound to benefit from it. First Resources, okay, there's a small rally, trying to break out. Okay, Bumitama, similarly. Okay, so as for the big cap stocks are like Olam, Wilmar. It requires so-called some rest. Okay, for Wilmar, it has because due to its previous strong rally, right now is consolidating or resting or doing a correction. Okay, so at this moment, last week I mentioned we should be watching out for 480. Okay, so we have to see whether this 200-day moving average support, so-called a soft support, will hold for Wilmar. Okay, so we just need like 1 or 2 weeks to observe, let it form a base or a support before we can think about trading for Wilmar. Okay, so what I mentioned about Wilmar is it's one of the biggest company in terms of commodities. All right, and if we look at previous record, back in 2007, where there are a lot of money printing, housing bubble and all this stuff, Wilmar was moving off to record highs. Okay, and it crashed together with the market, but it recovered earlier or faster than most of the other companies, other countries too. Okay, so Wilma, you should probably watch out, because since I've mentioned that it's going to be in a commodities bull market, and bull market will tend to last, for a few years if this inflation is not being addressed. Okay, so I mean, this is a weekly chart, and what we are seeing here is like higher high, higher low, higher high, higher low, higher high, higher low. Okay, it's still on an uptrend. Okay, so we like to see after this 3 weeks down, right, what's going to happen over the next few weeks, and probably hopefully we can position ourselves for the final run. Okay, so that's all I have for today. See you guys next week.